Hello, and welcome to our series on the US and French tax systems. If you're living, working, or doing business between these two countries, understanding how each tax system is structured is essential. Different systems mean different rules, responsibilities, and planning strategies. And the better you understand how it all fits together, the easier it is to stay compliant and make smart decisions. Let's start with the big picture: how each system is organized and who's responsible for collecting taxes. In France, things are centralized. Most major taxes, like income tax, corporate tax, and VAT, are handled at the national level. Wherever you live, the rules stay the same across the country. Social contributions are overseen by the Ministry of Social Affairs, Health and Labor, but they coordinate closely with the Ministry of Finance to keep everything aligned. So, whether it's income or contributions, the system is centralized and consistent nationwide. Now let's look at the United States. Unlike France, the US doesn't have a single unified tax system. It's layered. At the top, you have the federal level, managed by the IRS. These rules apply nationwide, similar to how France applies its taxes uniformly. But here's where it diverges. The US also gives each state the authority to set and manage its own tax rules. For example, some states collect personal income tax, while others don't. Some impose corporate taxes, property taxes, or even local level taxes, from counties to cities to school districts. The result? A system where tax rules can vary widely depending on where you live or do business. Another key difference is how each country funds public services. In France, government revenue comes primarily from three sources: income tax, social contributions, and VAT. Think of VAT as a tax that follows the product, adding up at each stage from production to the point of sale, while sales tax waits quietly until the very end, when the consumer makes the purchase. Together, these taxes don't just support the government. They cover about 55% to 60% of France's social safety net, including healthcare, retirement, and family benefits. In the US, the system is more fragmented. Revenue is drawn from several types of taxes, often collected by different levels of government: federal and state income taxes, sales taxes on goods and services, added at checkout and managed by states or cities, property taxes usually collected locally, payroll taxes, which fund programs like Social Security and Medicare. The types and amounts you pay depend heavily on where you live, shop, and work. Now, let's talk about the filing experience. In France, most employees benefit from a relatively streamlined process. Thanks to prélèvement à la source, taxes are automatically withheld from your paycheck by your employer. You still file an annual return, but for many people it's pre-filled and just needs to be reviewed and confirmed. In the US, it's a different story. Even if taxes are withheld from your paycheck, you're still required to file a tax return every year. It's your responsibility to report your income, apply for deductions and credits, and make sure it's accurate, at both the federal level and often the state level as well. So how do the systems compare? Let's recap. France has a single national tax authority. In the US, tax responsibilities are shared. Federal, state, and even local governments each collect their own. France raises revenue primarily through income tax, social contributions, and VAT. The US draws from income tax, sales tax, property tax, and payroll tax, each managed by different levels of government. In France, taxes are withheld automatically from your paycheck, no action needed. In the US, it's similar. Employers also withhold income tax, but individuals must actively file their own tax returns, often in multiple jurisdictions. In the next episode, we'll zoom in on personal income tax and explain why US tax season can sometimes feel like a full-time job. Stay tuned.